in the middle of the up move, silver begins to move. It moves faster then and much further than gold did. I think that the biggest enemy of the US dollar is not in Beijing or Moscow, it's in Washington.
Hi, this is Mike Maloney, and I've got Rick Rule with me once again, and this will be the Golden Rule. So, Rick, how are you doing?
I'm fine, Mike. The better for being on with you. Thank you for having me back.
Okay. We've got a lot going with interest rates and real estate and China. So it's on the U.S. side. It's on the Chinese side. I was wondering what your take is on interest rate, real estate, and anything else that is interest rate sensitive.
Boy, we don't have enough time for that. I have to say, Mike, I'm impressed with, thus far at least, the resilience of the U.S. economy in the face of a higher cost of capital. Unlike many of your viewers, but perhaps like you, I remember the decade of the 70s. So I have seen what the prologue might look like. And I remember in the first half of the decade of the 70s, although I was quite young then, there was a lot of consternation over the fact that real interest rates had risen and the economy didn't react. People had been schooled, I believe, to think that good times would always last as a consequence of the 50s and 60s. And the behaviors didn't change much in the first part of the decade of the 70s. They changed with a vengeance, of course, 4 years in. And I wonder if the economic strength that we're seeing and the confidence that we're seeing in the banking sector and in other sectors is really part of the same function. In other words, I wonder if we're going to reel in a delayed fashion from the punch that is higher interest rates. I have to say I'm delighted with the relative strength of the U.S. economy. While I've always been nervous, I've joked on your show before that between Doug Casey and I, we've correctly forecasted 17 of the last 3 declines. I hope that our forecast is wrong, Mike. When you talk about go ahead.
I've got to say that when you forecast 17 of the last 3 declines, the scale of the declines and what you can make as a crisis investor completely make up for the times that you're wrong.
I think that's very right. I think there's a lot of lessons there. Buffett's lesson is invest in very high quality companies and very high quality businesses. Understand that every now a circumstance that comes along that cuts the price in half, but it doesn't change the value at all if you invest correctly. A different lesson is, of course, liquidity. Liquidity gives you the ability to take advantage of illiquid situations rather than being taken advantage of. Those are all important lessons. And the point that you make about crisis investing is probably the best. You make money buying in circumstances where assets are cheap and then hanging on for dear life. The strategy that you described puts time on your side as opposed to making time your enemy. And at 70, I've learned that's critically important.
Yeah, well, I made the mistake. I usually stay heavily invested and I'm very light on cash. And I just had to make a video telling my insiders that for the very first time, I actually had to sell some silver because some of my investments are very illiquid. I've got a bunch of silver explorers and gold, and they're all private placements. So I actually have the stock certificates. I mean, it would take weeks to mail them into my brokerage house and get them on my platform so that I could actually trade them. And then I've got a bunch of Tesla Roadsters, the originals, which I believe are 10-baggers. And that's not very liquid. I'm going to Phoenix to register a bunch of cars because I might sell one of them. But for the very first time since I've been accumulating gold and silver, I actually had to liquidate some because I was in a cash crunch.
Right.
My book, Amazon crushed the sales of my book by, it's almost like shadow banning me. They made it so that it's unsearchable. You can't, it starts to show up now. But on the third day of the launch, they changed my listing to a video game. And then that took 2.5 months to fix. And it lost all of its browse nodes, which are the different departments it's listed in, so that you can find it in a search by saying investing in gold. And it pops up. Well, it didn't. And so they crushed the sales. And so right now I'm running a special on it. It's half price because on the 15th, they're either going to liquidate my inventory or send it back because it's not selling well enough because they crushed the sales. That's the reason. It's just been an awful experience. But getting back to liquidity, what you said was very profound. And I found that running things a little bit close and being too heavily invested and not enough cash position for the very first time in 20 years, I got in a bind. But I do think, I'm hoping that gold and silver don't break into new highs right now, that they do a little further pullback so I can reaccumulate my position at a lower cost.
Well, you said, Mike, you said so many important things there. The first is that liquidity, almost irrespective of who you are, is important because if you get cash short, you are forced to do things that you otherwise wouldn't want to do.
Right.
The second point that you made, perhaps without realizing it, is that if you regard your gold and silver as mediums of exchange that are simultaneously stores of value, you can consider them liquidity if you are willing to sell them if a better opportunity comes up. Too many people, Mike, that are in our community refuse to sell their gold and silver when the price is down, when the price of other things is down more. I have many bad habits. I won't enumerate them. But one bad habit that I don't have is an unwillingness to sell. If there are periods of time when I need my gold and silver as liquidity, that's why I own them. For me in particular, gold isn't a speculation. For me, gold is insurance and frankly, wealth. If there are other things that I can use the liquidity represented by gold to increase my overall wealth, I'm willing to do it. The same thing, frankly, with silver. I regard silver personally as a speculation. I regard it differently than I regard my gold. And I am eminently willing, personally, to use my silver for liquidity if, on a temporary basis, a more attractive opportunity comes along.
Yeah, and it's highly liquid. I mean, I converted it into cash almost immediately and was able to alleviate the crunch that I was in. But, you know, I see them, I believe that gold and silver have, in the long term, are guaranteed by the world's central banks. They're guaranteed to go up. Why? Because we have a guarantee that they will always create more currency and the currencies will go down in relationship to gold and silver. But when I look at investments, I look at ratio charts all the time because it isn't what is the dollar price of gold? What is the price of real estate measured in gold? What is the price of stocks or anything else measured in gold and silver? And I do believe that do you feel that there is another leg to this financial crisis, at least one more? I mean, the 2008 financial crisis came in like 4 different waves. And the first ones were really spaced out, and then it got closer and closer for the next few waves, the final one being like the Lehman meltdown and everything. I mean, almost complete global financial meltdown. And so this one, we've only had one wave, Silicon Valley, which, also Signature and Credit Suisse, that all happened in March, basically. And so what do you feel?
I believe that the crisis represented by Silicon Valley Bank, by the banking community, is manageable because there's so much confidence in the system. Banking is all about confidence.
But what happens when the confidence evaporates?
That's a very, very, very real question. If we have a circumstance like 2008, where a so-called black swan gets in the way, a crisis can evaporate very quickly. And in that sense, the assets of the Federal Deposit Insurance Corporation are nowhere near sufficient to handle the mark-to-market losses in the banking system. But let's set that aside just for a second. We have a circumstance where I think that the system itself is over-leveraged at every level. I think, obviously, in the United States, at least, that the federal government is over-leveraged. Many state governments are over-leveraged. Many municipalities are over-leveraged. And many of your listeners are over-leveraged. And what that means is that if you have a sort of an asymptomatic event, even if some people have foreseen it, the damage that can do to the broad economy, but also to confidence, is something that individual investors have to insure against. And I do think that the banking system, ex-federal support, is really challenged. You and I talked, Mike, a couple of months ago about the fact that humankind in the period 1982 to 2022 lived through 40 years of the most benign economic climate experienced ever. And the consequence of that is, I think that people became overly complacent, they became overly confident, and they didn't prepare as well as they should to take care of themselves in circumstances where liquidity was required. And I think that sets the stage for the sort of difficulties that you describe. By the way, I'm not a gloomster. I think 10 years from now, we'll be better off than we are today. I'm just afraid that we have a reckoning to go through to get from there. But let's look at some things that scare me. And I'll tell you the thing that scares me the most. If I was looking for, black swans in the United States, the thing that scares me absolutely the most is the proliferation of high yield exchange traded funds, ETFs that invest in junk securities. There's several $1 trillion worth of this stuff, and they're highly liquid, and they're owned in small amounts by a bunch of people that I don't think have done enough work to understand the underlying security. These people, in the rude parlance of Wall Street, are yield whores. And what scares me is that although the ETFs are highly liquid, the underlying securities that they own are highly illiquid. And if we have a concern about credit that reaches the common man, if you will, and if they begin to redeem those ETFs, the managers are forced to sell the underlying assets. And of course, the best assets are the most liquid. They get sold the first. What really scares me is you have a circumstance where there's broad spread redemption in the junk ETFs, and the underlying bonds don't have sufficient liquidity to fund the redemptions. That circumstance in my younger years, or that asset class, these junk bonds, become described as owl bonds. We call them owl bonds because when the portfolio manager calls the broker to sell the bond, the broker says, "Too-hoo, too-hoo." And a circumstance where you have a run on the bank that's represented by an ETF. If you want my single biggest fear, that's it. I hope it doesn't materialize, but I sort of feel like privately placed high yield corporate debt is the mortgage-backed security of this decade. And Michael, honest to God, I hope I'm wrong.
Yeah, we can call them GTZ bonds, going to zero.
Let's see. I noticed too.
Right now,
as long as we're making people depressed, I was in Midtown Manhattan not too long ago in a building that you know fairly well, and that building, it's a Class B building, but a nice building in a wonderful part of New York City. It's 80% vacant.
Yes. Globally, more than half of the office space is vacant right now. And so it's just something, it's a disaster that I see, right, especially with rising rates.
Yeah.
With rising rates, when a big entity has to refinance a building, the building's value isn't based
Yeah.
on the structure or the location, it's based on the cash flow.
The income,
Do
correct.
they have, yeah, it's income
Correct.
and future potential income. And there is no future potential income visible on the horizon right now.
No, that the Class B and even some of the A and AAA office space in some cities that appear to me to be unsustainable in their current configuration is certainly scary. But on the other side, Mike, you have to look at the fact that we still live in a society that is innovative enough and creative enough that 6 young adults semi-adults can take over a garage in Sunnyvale, California, and out pops Google or out pops Apple. My belief in the longer term is that our individual tenacity and creativity is so spectacular that we can overcome our collective stupidity.
If government gets out of the way and allows that to happen, it has become so difficult to open up a business and get things started these days.
Yep.
It's like at least 10 times harder than it was back in the 80s.
It's interesting you say that, Mike. I think that I'm involved in in retirement in forming another bank. And it's really been an interesting process. My politics, my philosophy, and yours are the same. I've actually found at the lower levels with the big banking bureaucracies, the OCC, the Fed, the FDIC, some remarkably smart, hardworking people. The problem is at the top in politics. The problem is that there are so many conflicting priorities that are forced on these bureaucracies, ultimately by the voters, but of course, really by the political class right now, that business formation is, as you say, very hard, despite the fact that there are some very good intentions among the people who populate the regulator. It's been a really interesting circumstance. This is the 7th de novo bank that I've been part of in my career. It's obviously been the most interesting formation for me, but I suspect it's taken at least a year longer than really prudent regulation would have required.
Wow. Yeah. So, what do you think about the expansion of the BRICS?
I think a multipolar world is a good thing. And I think that there was no domestic impetus necessarily for the expansion of the BRICS. I think that the biggest enemy of the US dollar is not in Beijing or Moscow, it's in Washington.
Yes.
If you look at what we as Americans made them do, you have to look, first of all, to the fact that the deepest and most liquid securities market in the world is the US Treasury market. And we're doing our best to wreck it. We're doing our best to wreck it because we're wrecking the credit quality of the issuer, the US government. At the same time that, separate and apart from the CPI, which I think is a fraudulent index, we are
CPI.
Yeah, we're guaranteeing people negative rates of return. When I construct a basket of the goods and services that I buy, I include government in my index, which the CPI doesn't include. And if you measure your cost of living the way I measure mine, the deterioration of the purchasing power of the US dollar is much closer to 7% than it is to 3%. So with regards to the US Treasury, if you buy a Treasury that's yielding you now 5 in a currency that's losing you 7% a year, the real yield on your Treasury is -2. That's not particularly attractive to the Koreans and the Chinese and the Saudis. And if you put on top of that the weaponization of the US dollar, the fact that if the US government doesn't approve of your policies, they can default, they can cancel on the debt you hold. And if you weaponize it, like we did through the SWIFT banking system, the extraterritorial imposition of US values on the rest of the world guarantees the slow motion decline of the US dollar as the reserves currency. The BRIC currency, I think, is a misnomer. It will not be a currency. There isn't enough gold on the planet, almost irrespective of the price you put on gold, to backstop all of the domestic transactions in a group of countries whose GDP is larger than the G7's.
Yeah.
The idea that they're going to have a common currency and politically suborn their individual national interests to the common good of the BRICS is a silly, silly fantasy. However, a gold-backed settlement mechanism where the trade surplus that China enjoys, as an example, with Russia, could be settled outside the US dollar system in gold, I think is a very interesting concept. I actually don't think it's going to occur, because I think as little as the Russians and the Chinese trust us, they trust each other even less. I could see a circumstance where Xi went to Moscow and said, you guys owe us the equivalent of $10 trillion, or pardon me, $10 billion in gold, please settle up. And I could see Mr. Putin saying to them, well, here's 100,000 bricks. And I don't mean gold bricks. I mean settlement bricks.
Yeah. It's the other than U.S. bonds, which they want to get out of because of the weaponization of the dollar.
Right.
But other than U.S. bonds, this is the only asset that they all hold. That's the same. It's completely fungible for them. Yeah.
I just don't see them trusting each other enough to make this mechanism work, except for in a very, very, very limited fashion for a settlements mechanism.
I don't think it's going to be redeemable for the consumer, for instance. Right.
Correct.
Right.
Correct. And ultimately, given that only 2 of the BRICS members run consistent trade surpluses, I don't think it'll be viable among the BRICS. At some point in time, U.S. hegemony gets replaced by the threat of Chinese hegemony.
Right.
I mean, this is just the nature of politics.
Right. Okay. So, what's happening with real estate in China right now? I believe it's Zhongdong Group that is currently. They've got the government has auditors looking at it, so it may require a government bailout of roughly $38 billion US. There's just so much going on, and real estate does seem to be collapsing in China. That would cause a slowdown in demand for commodities, copper and cement and all of that stuff, and derivatives tend to transmit crises around the world. I showed a chart in one of my last videos of all of the different recessions for, I think, 26 different countries, or maybe it was 32 countries globally, and how they come in waves that are aligned. And it used to be the US would have a recession and our imports would slow down. We'd buy less from other countries. And 6 months to 3 years later, the other countries would have a recession. But you could see these stripes in the chart, and they've become they've gone from semi-synchronous to synchronous to super synchronous to hypersynchronous. And so what are your thoughts on China? And what are your thoughts on, Janet Yellen said we will never experience another crisis in our lifetime. Well, we already had the financial crisis of March of 2023. I believe that was just the first leg. If some other crisis hits us, could it happen anywhere on Earth and then transmit to all other economies? And what will be the speed of that crisis?
Well, the answer to could it happen is clearly yes. I'm not an economist. I'm a credit analyst. And from a credit analyst's point of view, what keeps the economy ticking along today in the way that it has in the past, with deteriorating credit quality and negative real interest rates, is simply confidence. Talking specifically about China, the Chinese economy is so opaque And the Chinese debt market is so opaque, particularly relative to the American market, which, despite its faults, is the most liquid and transparent market in the world, that it's difficult to draw conclusions about the Chinese market. We don't know anything about the credit quality enjoyed, if that's the right phrase, by the official banking sector in China. And the official banking sector in China is, at least allegedly, in much better condition than the non-bank financials in China. One thing that you can say for a system like the United States is that there's reasonably good feedback mechanisms. They can be, of course, ignored, which I believe they're being. But in China, where you superimpose a 10,000 person elite on 1.4 billion people, there is no feedback mechanism. You don't get to see until too late the stresses involved in credit or in provincial investments or in real estate.
And that
until it's
lack
too late.
of transparency translates into storing up a whole bunch of energy until everything falls apart, right? I mean, it'll happen all of a sudden because the public, nobody in the financial sector can see it coming. The government keeps it hidden, right?
Well, yeah, that's right. And the consequence of that is that what I choose to do, despite the statistical cheapness of Chinese equities, is avoid them because I'm relatively confident now that I don't know enough about them.
You know, just today, there's an article on Financial Times that says U.S. companies see China as uninvestable. And you just basically said that yourself. It's uninvestable. What happens when, this starts becoming a global thing and everybody wants to stay away from China as an investment, when that's one of the things that has supported their entire stock markets and structure for the past decade?
You make a very important point. A lot of China's growth has had to do with incredible amounts of foreign direct investment. And to the extent that the Chinese themselves, for political purposes, discourage foreign direct investment, which they seem to be doing, and to the extent that there are no longer surpluses generated in China to support the level of growth that they have seen, there's a fairly ugly reckoning. It's important to note that Chinese society has been prodigious savers. Some of that's been forced from above, which is to say, the savings have been socialized by state-controlled firms paying wages much below the world standard while selling products on global markets at world standard prices, with the surplus, the economic surplus, being expropriated by the state rather than having been enjoyed by the workers. There, I think, has also been a cultural tendency among Chinese people as individuals to be prodigious savers. If you look, as an example, at the fact that Japan is still nominally solvent, despite decades of negative growth,
Right.
The tolerance of the Japanese citizenry for the excesses of their government and the fact that the Japanese economy has produced surpluses, which the citizens were willing to save, has, at least up till now, kept the system solvent. In
but when
Japan and China, you have demographic trends, which is to say, a rapidly aging population that makes you wonder how long this circumstance can continue, even if confidence continues. I'm not smart enough to tell you, of course, whether confidence will continue.
You know, in the U.S., when you take non-financial corporate debt, sovereign debt, and personal debt, it adds up to 300, a little over 300% of GDP. So you're talking about 3 years of the entire economic output of the country. Japan is over 6 years.
Yep.
And so, you're talking about an inevitable train wreck that has to happen because of the aging of their population, the few people that have to carry everyone else on their shoulders, and borrowing themselves past, I mean, they're past their eyeballs. They're way underwater. China has about 3 years of GDP as far as their borrowings. The U.S. has a little bit more, actually, when you include personal non-financials and sovereign. So I don't know. I see a train wreck happening. If that train wreck happens, I see markets crashing or the financial industries possibly freezing up for a little while, which brings me to the last topic, silver. What do you see in the short, medium, and long term? Things could go along well for another. I believe that there's absolutely another leg to this crisis because of the rate at rates rising. How fast rates that Powell put up rates. It's never been done like this in history, where they just slam them up in such a short time period by such a percentage increase. And so there may or may not be another crisis, but I see spectacular things for silver in the future. What do you see in the short, medium, and long term?
I'm not one of those who thinks in the near term that a crisis will be good for silver. In my experience, in a liquidity crisis, everything gets sold off because the sale decision isn't made by the investor; it's made by the margin clerk. And
okay, so that covers the short term. Yeah.
I mean, that's really truly problematic.
Yes.
If we have the liquidity crisis that you expect, I suspect that capital markets will respond the same way they responded in 1987 and 2008, which is to say everything will sell off. The policy response to that will likely be money printing on a scale that we've never seen before, and assets that have traditionally
how
responded.
many times have you said that since 2007? Money printing on the scale, which I'd say is currency printing. You can't print a store.
That's a good point. That's a good point. That's a good point. But we've also had, putting it in context, we've had GDP growth, and we've had an amazing
keep up with the currency.
We've had amazing margin, which is to say economic margin generated in the United States. At some point in time, you push on the string, and there's no push left. And so not the nervousness, I think if we do have a liquidity crisis, irrespective of the source, the policy response will be the same as the policy response before. The difficulty is that the negative impacts of negative real interest rates and quantitative easing and debt and deficits are cumulative and compounding, which is to say that we're pushing liquidity in the system, or we would be pushing liquidity in the system the same way that we did in 1987, the same way that we did in 2008, but the system has many more encumbrances, many more imbalances than it had then, so that the response to the policy, I think, will be less dramatic on the good side and more dramatic on the bad side. Now, let's return to silver. Let's get away from macro and let's talk about silver. My experience with silver, and I'm not sure why, is that silver is a late cycle mover, which is to say in precious metals bull market, the gold trend is established by gold.
Yeah. And then it drags silver with it later.
In the middle of the up move, silver begins to move. It moves faster then and much further than gold did. I assume that's because of silver's low unit price, which is to say when the bull market democratizes and people with less means want to participate, the easiest and best way for them to participate is in silver. I'm making this up, by the way, Mike. I don't know why this is true. I just know.
That was my theory about what happened last time around, is that, gold had been $35 an ounce, and then it broke $400 an ounce in late 79. And the average income back then was just below $10,000 a year. So a guy that's, in his 30s, you've got the bigger investors that are toward the end of their lifetime, but a guy in his 30s or 40s that sees that gold has gone up so much, rushes to the bank, takes out his life savings, which might have been $500 then, with an average income of $10,000. Who knows? But rushes into the coin shop and says, I want to buy gold too. And they drop one coin in his hand. At that point, he goes, oh, is that all I can get? How much is the silver? Oh, well, you can get 50 of those for every one of these. And suddenly, in just just a few months, you could only get 14 ounces of silver. So way outperformed gold, especially at the very end. But it did lag, like you say, and it is. I like to say that it's psychological. So it's psychological. These things run in waves and cycles, and this is based on human psychology.
And interestingly, Michael, what you describe is more pronounced in poorer countries, particularly in South Asia, where there's a cultural predisposition to precious metals. At one point in time in my career, frequented the United Arab Emirates a lot. And there were a lot of Indian and Pakistani guest workers there. And you could go to the gold souk, and what you would see is that South Asian people would save in precious metals. And which precious metals they chose was really a consequence of their economic circumstance. Many of the labor force wasn't able to save in gold, so they would save in silver. And I think one of the things that you see in precious metals bull markets is that when the narrative is established, not just in the United States, but internationally, that silver becomes the savings instrument for the poorest half of humanity. And while their individual impact is, of course, less dramatic than the impact of the average American, the sheer numbers and the cultural predisposition in countries like India, Pakistan, Bangladesh, Sri Lanka, China, Korea, the centuries-long familiarity with precious metals often means that in circumstances where confidence is called into question, that the unit value of silver makes it the preferred savings instrument.
Yes. One of the preferred investment instruments in China has been real estate. As this crisis unfolds, you mentioned the savings of the Chinese. When they head toward a safe haven during a crisis, what happens when all of that savings in China and their proclivity to buy gold?
Right.
So what happens to the international gold price will it trigger the gold price to also be rising in dollars at the same time?
Well, I think the answer to that is yes, but that's too easy. You set me up too simply. Let's make a very different case for gold that doesn't require the collapse of humankind.
I like that.
In the first instance, the situation doesn't need to collapse so much as deteriorate, which I think it will. I point out every time I have the opportunity that the market share that gold and silver enjoys as a percentage of total savings and investment assets in the biggest investment market in the world, which is the United States, is only 0.5%, which is to say 0.5% of the total value of savings and investment assets in the United States.
And what was it back in 1980? Wasn't it like 8% or something like that?
I'll get to that, but we don't need to be dramatic.
Okay.
I mean, other than selling newsletters, drama's not worth much. The 4-decade mean market share for precious metals in the United States was 2%. So if debt and deficits and all of the difficulties that you describe begin to play on the American psyche, not to the point in time that they cause panic, but rather to the point that we simply revert to mean, demand for precious metals related investments increases fourfold. And that's my base case. Now, you make a separate point, and that point is a very different point, and it is dramatic. Please don't make it show up in the headline for this interview. But although there were no reliable statistics at the time, J.P. Morgan Chase believes that the market share of precious metals and precious metals related assets relative to other savings and investment assets in the United States in 1981 was between 6 and 8%.
So 12 to
really,
16 times higher than what it is
yes,
now.
yeah.
Right.
But in
You know,
order to
I was just
claim to,
comparing the gold price to the growth of the M2 currency supply.
right,
And if it goes to where it was in the balance that it was at in January 1980 when gold peaked, that requires a $10,000 an ounce gold price.
right, right. And you said, I think there's two important things there. The first is that the case for owning physical gold and silver, or if you're an investor or speculator, gold and or silver stocks, is ironclad. It doesn't need to require the collapse of the institutions of humankind. It only requires reversion to mean. The second point that you made is, I think, maybe more profound for the listeners. So many people who listen to these interviews, Mike, are long gold and silver for the wrong duration, which is to say the short term, and for the wrong purposes. And many of them slavishly look at the near-term movements in the gold price. The gold goes from 1935 to 1955. And these people feel vindicated. If it moves from 1975 down to 1925, they fall into despair. You own gold because you think in the wrong, not the right, in the wrong set of circumstances, gold isn't going to go up by $100. It isn't going to go up by $200. It's going to go up by thousands of dollars. You own it, frankly, hoping, perhaps if you're Christian, praying that you're wrong. But you aren't owning it for $100 moves. You're owning it for $1,000 or $2,000 moves. If you look back,
or for it to stay the same while everything else falls.
Correct. Right. If you look back only now, 23 years, in the year 2000, when gold, frankly, was a four-letter word that nobody could spell, the price of gold was at what, $253 an ounce?
Yes.
10 years later, which is not a phenomenal amount of time, the gold price had increased to $1,850 an ounce. So people who are looking at the stuff with regards to a $100 move are missing the point.
Yes, exactly. Right. It's a long-term strategy for protecting yourself and exposing yourself to the benefits of currency creation. With that, I think we need to wrap this up. We're getting a little long. So I want to thank you so much. This has been phenomenal. So I hope to see you back very soon.
I hope in the waning moments of this interview, you'll let me invite your listeners to ruleinvestmentmedia.com, where I personally will, on a no obligations basis, rank your natural resource stocks. Go to the site, list your stocks. I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues where, if I think my comments have any value. And finally, if you like to save in gold and silver, but you're interested in having some liquidity, our new bank, Battle Bank, proposes to do exactly that. If you are uncomfortable for any reason with your incumbent bank, please check out Battle Bank. Either go to battlebank.com or at the Rule Investment Media website, under questions and comments, ask for information about Battle Bank, where, among other things, you can use your gold and silver for liquidity without having to sell them.
Yes. So you're talking about loans against the gold and silver as collateral.
Correct.
Okay. I just want to caution everybody, if you're going to do that, don't go right out to the end of your margin. If it falls, you're going to get basically what ends up as a margin call. But it is a great strategy for being able to use that liquidity short term without having to sell your position.
Correct.
Okay. Thank you very much, Rick. We'll
Michael,
see you next time.
Michael, thank you. We need to turn the mics around. I need to interview you so that we can sabotage Amazon's plans around your book.
I don't know if it was plans. You know, my mind goes there because of the genre that I'm in. The commenting on finance and politics and the government. I'm a very suspicious person at this point. So are they doing this on purpose? Am I shadow banned?
Well,
It's just
Amazon,
their giant bureaucracy that is just a mess. That's what's causing it.
hopefully
But
their
they,
algorithm will respond to incentives. And if we can generate some demand for the book, it might slap them across the chops and wake them up.
yeah, they treat their their sellers like the enemy, though. If you're buying something on Amazon, it's a great experience. But if you're trying to sell something on Amazon, it's like dealing with the IRS every day of your life. I want to thank everybody for watching. Thank you, Rick. We'll see you next time. So,
Thank you so much, Mike. I enjoyed it.